This is Matthew Cratter from Trader University, and today I want to talk about a few different ways of holding Bitcoin that I've been getting questions about. There's GBTC, which is this Bitcoin Trust, and then there are the different Bitcoin ETFs, the futures-backed ones, and the spot-backed one, which is available in Canada. So I thought I would cover those briefly today. GBTC is not an ETF, it's actually what's called a trust, and when you buy it, you're buying shares or trust units in an underlying trust that itself holds the Bitcoin. Now the problem with these trusts is they traditionally tend to trade, just like a closed-end fund, they tend to trade at a discount to the assets, the actual holdings that are there. So for example, right now the price per share or per unit of the trust is $12.25. And these are all numbers as of the close of trading on Friday, because GBTC does not trade over the weekend while BTC does. But the value of the shares themselves or the units themselves is $12.25 a piece. But the actual, I should say that's the market price of each share. But the actual value of each share in terms of the underlying holdings is $17.85. So I think if you do that math, you get roughly 31%. So it's trading at a negative 31% premium, in other words, a 31% discount. The trust units or the shares are trading at a discount to what they're actually worth on the open market if the trust were to be liquidated and all the Bitcoin were to be sold. Now this discount or premium to NAV has moved around over time. For many years, ever since its inception, it always traded at a premium because there weren't good ways of holding Bitcoin back then. This was a very easy way of doing it. And so it traded actually in excess, in other words, at a premium to what the underlying holdings were worth. And then this reversed sometime in March of 2021, roughly when Bitcoin peaked, or at least peaked the first time. There was also a November 2021 peak. But roughly when this peaked, the discount, it went from a premium to a discount, and that discount widened. At first it was just a couple percentage points, and now it's sitting at 32%. So it's trading at this huge discount to the underlying value. As a result, Grayscale has been trying to get the SEC to allow them to convert this trust into an actual Bitcoin spot ETF, where there's this arbitrage between the ETF and the underlying Bitcoin. Unfortunately, the SEC turned them down, and now Grayscale is suing the SEC, saying that they're not applying their rules consistently, and they're discriminating against Bitcoin spot ETFs. So we'll see how this turns out, but the real question here is, what is the investment opportunity? And that's what I've been getting a lot of questions about. So let's make the math really easy here. Let's say that GBTC is currently trading at a 30% discount to NAV. If it were ever to be converted into a spot ETF, this would trade at a 0 discount to NAV. So it would basically go from 70 cents on the dollar to 100 cents on the dollar. You'd make 30 cents on a base of 70 cents. And so even if the price of Bitcoin stayed right where it is right now at about $19,000 per Bitcoin, you would make basically 30 divided by 70. You're basically buying the trust at 70, and it's going to go back to 0. In other words, the discount is going to narrow. You'd make 30 points on a 70 investment. That's about 42.86%. So even if Bitcoin doesn't go up, if you buy the trust here and then it gets converted to a spot ETF, or somehow this discount goes away on its own and it goes back to trading very close to a 0% premium, 0% discount, you'd make about 43% on your money, which is great. The only problem is it might take years for this to happen. And so this is the calculation you have to do. None of this is investment advice. I'm not telling you what to do. As you'll see, I prefer to hold Bitcoin itself and hold it in my own custody. But if you want to play this trade, this is the math you need to do. Basically, you're paying Grayscale a 2% management fee every year for the privilege of holding this piece of paper. And so you have to do the calculation that if it's trading at a 30% discount and you're paying 2% management fee a year, it's going to take you roughly 15 years to break even, just 30% discount divided by 2% management fee. So you're basically bleeding 2% a year, and you hope that the discount narrows faster than that. The math is a little bit different than this because you're actually taking out value, or Grayscale is taking out value when they take out this 2% a year. But this is roughly the calculation. If you go long GBTC, you're betting that Bitcoin stays at this price or goes higher, and you're also betting that the discount narrows. And if it takes 15 years and Bitcoin stays right where it is, you'll roughly break even. That's not too bad, but the problem is that there are other risks involved. For one thing, if you have a shorter term holding time horizon or holding horizon, the discount could widen over time. There's nothing to say it can't go from a 31% discount to a 40% discount or a 50% discount. We just don't know, and anything can happen in markets. And so you might end up getting trapped there, and maybe you think you want to hold this for 15 years or more, but you don't really want to, and so then you have to exit at a loss. And so this could happen. This discount could widen even if the price of Bitcoin doesn't go down anymore and stays here. In fact, you could have a situation where Bitcoin goes up a little bit and the discount widens, and you still end up losing money with GBTC. So that's one problem. The problem is that huge management fee. A 2% management fee is really outrageous. That's a very high fee for these sort of things. But they're still able to charge it because there's no good spot ETF in the US. The other consideration is not your keys, not your coins, not your keys, not your Bitcoin. If you buy GBTC, you own units of a trust or shares of a trust. You don't own Bitcoin itself. And the problem with this is GBTC, they have to store their actual Bitcoin somewhere, so they buy real Bitcoin. They have to store it somewhere. They can't just keep it in their house because they're highly regulated. And it turns out, at least based on my research, that they store their Bitcoin, their actual physical Bitcoin, if you want to call it that. There's their real Bitcoin or BTC. They store it with Coinbase Custody. So if you're going to buy GBTC, you have to like Coinbase. You have to be bullish on their security and their custody solutions. And the big problem with this, which I've talked about in many videos, is that Coinbase Custody carries a insurance of $320 million per incident and overall. The problem with this is they're managing, they're holding something in excess of $20 billion worth of crypto assets. So you have insurance of $320 million per incident or maximum insurance, and then you have $20 billion worth of assets, crypto assets, on Coinbase Custody. And who knows what percentage of that is Bitcoin, but I imagine it's at least 20-25%. Of course, Coinbase Custody could have a big ETH hack or Solana hack or something else that they're holding on in their cold storage, and that might end up using up all of this insurance, for example. And then if there's a problem with the Bitcoin that GBTC was holding at Coinbase, you'd be in trouble. So this is always the problem. None of these exchanges, none of these custody solutions have enough insurance to cover their underlying holdings. And even if they did, then you need to go do due diligence on the insurance companies and see whether they're solvent, what their exposure is. So if, for example, there's a hurricane in Texas and a hurricane in Florida, and these insurance companies get wiped out, then they're not going to be able to make you whole on your Coinbase Custody, for example. This is the problem with GBTC. There are just so many layers, and this recreates the fiat financial system of trust, which we're trying to get away from in Bitcoin. The whole point of Bitcoin is you don't have to trust Coinbase Custody and Grayscale and Lloyd's of London or whoever their insurance companies are. So this is the problem with GBTC. Next, we move on to BITO, which is the Bitcoin ETF that's available in the US right now. Unfortunately, it's futures backed. It's not backed by actual Bitcoin. So it trades based on the Bitcoin futures prices. In addition, it trades at a nearly 1%, a 0.95% management fee. So you're sort of bleeding money while you're holding this. The problem with these futures backed ETFs is they're basically built to lose money. The only way you can make money with them is if Bitcoin goes up fairly rapidly. But the problem is you have this what's called negative carry while you're holding it. So the way these futures ETFs work is they will buy Bitcoin futures. So these are the CME, the Chicago Mercantile Exchange futures on Bitcoin. And what something like BITO will do is, let's say they'll buy the September 2022 futures, which are trading at 19,655. As we know right now, Bitcoin itself is trading closer to 19,000. So what happens is, as this futures contract gets closer to maturity, it does what's called rolling down the curve. So it rolls down to 19.4, then it rolls down to whatever the spot price is. So right now the spot price on Bitcoin is approximately 19,000. When this contract expires or matures, it's going to be trading, if it expired or matured today, it would be trading, it would quickly move down to 19,000. So you would move whatever $655 divided by 19,655. So what this means is this is bleeding money every month. You basically have the futures in contango. Here's the chart and the various futures prices. And what happens is if you're long Bitcoin futures or any futures that are in contango like this, you basically roll down the curve. And so you're slowly losing money over time. And this gets passed on to the holders of BITO. So this is a terrible product. It basically burns money. Gary Gensler should never have approved a product like this instead of a spot ETF. But this is what we get in the US with our regulators. Now, ironically, the twin of this, BITI, which just came out, I think it just came out a couple weeks ago. This is a bet. So BITO is a bet that Bitcoin's going to go up. It's a bet on a long position of Bitcoin. BITI is a way of shorting Bitcoin. Again, it carries the same expense ratio or management fee, 95%. So it's an expensive way to hold things. Ironically, this is a product that will make money if Bitcoin doesn't go anywhere, because in the same way you lost money rolling down the curve with the BITO ETF, with this one, if you're short these futures, you will make money over time as you roll down the curve. Now this makes the huge assumption that the spot price of Bitcoin stays constant. You'll still make money on BITI. If the price of Bitcoin goes down, you'll make even more money because you're short Bitcoin and you're rolling down the futures curve. But the real problem here is that this is an asset that can go up a lot. I think Bitcoin's going into the millions of dollars this decade, and this is not something that you want to be short. If you want to short Bitcoin or play around with the futures, I would suggest you just learn how to trade the futures themselves, and that way you can avoid all these management fees and all these complexities. But this is how BITO and BITI work. They have these very strange dynamics because they're backed by futures and not by Bitcoin spot. The only ETF that I know about, the only major one that is backed by spot Bitcoin ETF, in other words, it trades based not on the Bitcoin futures, but on Bitcoin itself, is, I believe it's called BTCC. It's this purpose Bitcoin ETF in Canada, currently holding quite a few Bitcoin, 23,346 Bitcoin. This is not a trust. This is an actual ETF. And as such, it will always trade in line with the price of Bitcoin. It won't trade at a premium or discount like GBTC does. The problem again with this is you're holding paper Bitcoin. You don't have to hold a wallet. It says it sells us as good things, but it's actually a bad thing. You actually don't have to hold your own Bitcoin in cold storage. Instead, you have to trust someone else to do it. It turns out BTCC stores their Bitcoin with the Gemini Trust Company. So you have to trust the Winklevoss twins, you have to trust Gemini, and you have to trust their insurance as well. And as we talked about with Gemini Earn yesterday, this is not really a company that you want to trust. It looks like the Winklevoss twins are going on a rock band tour this summer. They're not exactly focused on what's happening in the industry. And even if they were, again, they're billionaires, they can do whatever they want. But even if they were focused, you're still dependent on Gemini trusts and Gemini custodians, insurance, and whether those insurance companies are stable. So there's a lot of research you have to do. Why not just buy BTC itself instead of buying paper BTC? If you buy GBTC or BITO or BITI or BTCC, these are all forms of what I call paper Bitcoin or Bitcoin IOUs. They're not the real thing. You have all this counterparty risk. You have to trust the custodian. You have to trust the operating, the management company. You have to trust the insurance companies. There's just a lot of trust involved. And it's basically a Bitcoin IOU. Will GBTC eventually be converted to a spot ETF where you can redeem it for actual BTC, especially if you're an institutional investor? Who knows? But in the meantime, you're holding a piece of paper. You're holding basically a security, and you're holding something that has huge counterparty risk through the custodian risk and through the insurance company risk. The nice thing about buying Bitcoin itself and holding it yourself is there's no counterparty risk. You might screw it up yourself, but this is what is involved in financial self-sovereignty, and this is the journey you have to make if you want to learn how to hold Bitcoin the right way. Not your keys, not your coins. It's best to hold Bitcoin itself, not one of these vehicles. Don't buy Bitcoin using leverage. It's very volatile. And be very careful holding Bitcoin, paper Bitcoin, or Bitcoin IOUs. If you want to learn about the best places to buy Bitcoin itself, I made this video back in May of 2022. I think it still holds up quite well, and it goes through the different crypto exchanges and brokers that you can use to buy Bitcoin itself, rather than relying on someone else to buy and hold it for you. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And please do share this video with your friends if possible, and let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.